Welcome to this Standard Life Investments Global Emerging Markets debate. We're going to be talking about the concentration of assets in the sector. Alistair, in terms of being long-term, some of these funds actually close, don't they?
Yes.
Why do they close, and how can you guard against that?
They close because they get too big and have too concentrated positions in stocks which aren't liquid enough to be scalable, up to running funds of multi-billions. Thankfully, at Standard Life Investments, we're in the fortunate position of being quite a young team with a new, quite flexible approach. So we're still a long way away from our liquidity ceiling in the way we could run the funds. We could grow them for many years and still have the same approach. In terms of the time horizon we look for in investment ideas, then typically focus on change takes us to maybe a 6 to 18 month time horizon where we expect our non-consensus positive to be realised and priced in by the market.
How do you identify the liquidity ceiling, as you put it?
Principally, it's the liquidity for us of our highest conviction ideas. So the 20 stocks that go onto our winners list are probably our biggest constraint in terms of scaling the funds. Fortunately, we have strong liquidity controls ensuring that only liquid stocks can go onto the winners list and that we can buy them in sufficient scale across all relevant portfolios for everyone to benefit from the consistently good stock picking of our highest conviction stocks.
If you look at the investment universe, it's a big investment universe. There's somewhere between 2,000 and 3,000 stocks that are theoretically liquid enough for us to invest in. So it's a matter of having tools to be able to home in on the ideas where there is significant change and therefore money-making opportunity taking place.
Timothy, from your point of view, what's your take on that issue of liquidity?
And liquidity is important, I think, in all asset classes, actually. Just going on to your kind of recapping on the first question, it's quite interesting when they say how long term do you want to invest for, because actually I think when picking funds you have to invest for the long term. A lot of great managers, great styles will underperform over 1 or 3 year periods. So if we're looking at a fund, it will be for the long term. That's the first thing. And in terms of fund closing and liquidity, sometimes it's seen as a negative thing, but actually it can be a positive, because if a fund's closing, that's could be because it enables them to stick to their knitting, sticking to what they do best. So we don't want a small cap fund to get too big. So it's often fund closing can be a good thing for the long term.
I think that in emerging markets, it's moving on a bit, and as an advisor, we're looking at non-correlation within portfolios. So in mature markets, we would balance a value fund with a growth fund. It's small cap against big cap. That hasn't really been available in emerging markets, but it's starting to become available. There are more funds now with different strategies, and we're looking carefully at that because, as I say, non-correlation we feel is very important. Liquidity is very important, and just to be in one fund now is perhaps not such a good idea as it was, or in fact there was really not much of an alternative previously.
Okay, I've got one. Yes, go on. Yeah, go.
One of the key issues here is that in the past, quality investment styles have dominated in emerging markets. So people have taken the view that if you're going to invest in things that are risky like emerging markets, then you want to have stable quality businesses and run with them for 10 years. So it's been a very successful investment approach, but it has led to the issue that a lot of these stocks look quite unattractively valued. So there's a huge polarization in valuations across emerging markets between what are perceived as the quality franchises and the rest of the market. So I do think looking forward, you need a flexible investment approach to be able to look at all investment opportunities, all potential companies as investments.
Absolutely. And when you look at what fund managers do, I mean, do you have an optimum fund size in mind? And it's a really terrible question to ask.
I don't think there's any hard and fast rule. I think there's a number of factors you have to look at, which areas they're investing in. I guess certainly there's a big difference in frontier markets, for example. I mean, they are still very, very small, less than 1% of global markets. So in frontier markets, I think funds have to be well below £1 billion, and we've seen a number of the high-profile funds closing recently. In global emerging markets, especially ones investing in blue chips, they can grow.
Anybody from the floor got a question? Yes, sir.
Hi, my name is Salman Ahmed from Lombard Odier. My question is on this talk, especially in the US, about designating some asset managers as systemic risk risk companies. Although, as we know, in the world we live in, regulation can be contagious as well. Do you think that kind of dynamic, if it comes through, affects this area, especially given the liquidity concerns or potential liquidity concerns you talked about on emerging markets?
Again, since the crisis, the nature of the financial system's changed quite significantly, right? You know, we see banks retreating from certain activities and other types of financial institution move in. The regulatory landscape was sort of designed mostly to supervise banks and a certain type of activity, but as shadow activity is increasing, then regulators and supervisors need to be aware that actually systemic risk may be located somewhere else, and if they're not set up to understand the nature of those risks, then their ability to, in a sense, get ahead of those issues and assess them through the cycle might be reduced. So I think it's inevitable that if these trends continue, right, and so you sort of see a relative shrinkage of the banking system, then supervisors will look to do more of this type of activity.
Hi, Emma Black from Tier 1 Capital. I'm just wondering where the panel sits on the active v passive debate in terms of, it's been mentioned earlier about flows coming into ETFs, for example, and what risk that poses on emerging markets.
That's one for you, Alistair, I think.
Sure.
Yeah.
I think one of the key problems with ETF investment is it gives you a rather unrepresentative sample of gems. So you get a lot of state-owned enterprises, you get a lot of energy, you get a lot of financials. These companies are big in the index, but to us, from a bottom-up perspective, they are not the most attractive part of GEM in terms of the up-and-coming companies, up-and-coming sectors and services. Some of the most dynamic changes taking place in emerging markets are not properly captured by the indices. So we're entirely in the active camp. We think ETFs are a very, very bad way of allocating money to EM.
Yeah.
Yeah, I would echo some of that, because as an advisor, we're faced with the active-passive argument. In very, very mature markets, the US is the best one. Our view is buy an ETF because nobody beats the S&P 500, so why bother, But I think in emerging markets, the argument swings the other way, and that is if you buy a passive, someone mentioned the China stock, the Chinese stocks that form so much of the index. Is that really what you want? I would go for an active fund in emerging markets because it's not mature. It's so disparate that I think a passive fund is not the right thing.
Gavin?
Yeah, I would agree again. I don't think it's an area where particularly big is beautiful. I think the best opportunities within emerging markets probably come from small dynamic companies that are growing, and you won't get that exposure within a passive option. So I think we're looking for fund managers who can find these sort of unearthed gems, which are going to be the growth companies of the next decade, not particularly the largest companies at present.
Gentlemen, thanks very much indeed for your optimism. We've been talking about concentration of assets in the sector. See you next time.